This is your global personal finance news flash for the first week of August 2026. In the next 10 minutes, we are going to break down the biggest money stories from the past 7 days and explain what they could mean for your savings, debt, investments, housing costs, and everyday budget. This week brought a surprising combination of good news and warning signs. The United States unexpectedly lost jobs. Global stocks rallied. Gold surged. Oil remained volatile. India kept interest rates unchanged. Japan's currency moved sharply. And Canadian homeowners are still facing an important mortgage renewal challenge. The headlines may sound complicated, but the personal finance lessons are surprisingly simple. Let's begin with the story that changed the market most dramatically this week. On Friday, August 7th, the United States released its July employment report, and the numbers surprised almost everyone. Instead of adding jobs, the American economy lost 23,000 jobs during July. Economists surveyed by Reuters had expected an increase of about 80,000. That is a significant miss, and the weakness was not limited to July. Earlier employment numbers for May and June were revised lower by a combined 103,000 jobs. The unemployment rate actually fell from 4.2% to 4.1%. But that headline number is misleading if you look at what happened underneath it. The labor force participation rate fell to 61.4%, its lowest level in about 5.5 years. Hundreds of thousands of people left the labor force, which helped push the unemployment rate lower even though hiring was weak. Wage growth also slowed to about 3.2% from a year earlier. So what does this mean for your money? First, it changes the interest rate conversation. The Federal Reserve held its benchmark interest rate between 3.5 and 3.75% at its July meeting. The central bank has been trying to balance two competing problems. Inflation remains above its target, while the economy may be losing momentum. This week's employment report makes a second problem harder to ignore. Financial markets quickly reduced expectations for another Federal Reserve rate increase in September. That matters because interest rates influence mortgages, credit cards, auto loans, business borrowing, savings accounts, and the value of many investments for borrowers. A weaker economy could eventually increase the possibility of lower rates. But do not assume that lower rates are guaranteed. Inflation is still a problem, and the Federal Reserve will also be watching upcoming inflation reports before making its next decision. For savers, there is another important message. If interest rates eventually decline, the attractive returns currently available on some cash and savings products could decline as well. So this is a good time to review both sides of your balance sheet. Know what you are paying on debt, and know what your savings are earning. Global financial markets rallied after the weak U.S. employment report reduced expectations of an immediate Federal Reserve rate increase. Reuters reported that the MSCI World Index gained about 2.4% for the week, its strongest weekly performance in roughly 3 months. European stocks also reached record levels, while the S&P 500 finished at a record high. Why would investors celebrate weaker employment? Because markets are forward-looking. Investors are constantly trying to estimate what central banks will do next. If a weaker economy makes investors believe interest rates will stay lower, the value of stocks can rise because borrowing becomes less expensive, and future profits may be discounted at lower rates. But there is a danger in this logic. A little economic cooling can be positive for markets. A serious economic slowdown is not, if employment continues deteriorating. Consumer spending could weaken, company profits could suffer, and financial markets could eventually reverse. So the lesson for everyday investors is not to chase this week's rally. Do not sell everything because the economy looks weaker, and do not buy everything because stocks just reached another record. Instead, ask a more important question. Does your investment portfolio match your time horizon and your ability to tolerate risk? If you are investing for 20 years, 1 week of market movement should not determine your strategy. If you need the money next year, however, market risk matters much more. One of the biggest moves this week came from gold. Gold prices jumped sharply after the weak U.S. jobs report reduced expectations for another Federal Reserve rate increase. Reuters reported that gold reached a 7-week high and was heading toward its strongest weekly performance since January. Gold is often treated as a safe haven asset, especially when investors are worried about inflation, currencies, geopolitical conflict, or economic uncertainty. But there is an important warning here. Gold can protect a portfolio in certain environments, but it does not produce income like a bond or a dividend-paying stock. It can also fall sharply. So, should you buy gold because it went up this week? Not necessarily. The more useful lesson is diversification. A strong financial plan does not depend entirely on stocks, bonds, cash, real estate, or precious metals. Different assets can behave differently when the economic environment changes. Your goal should not be to predict which asset will win next week. Your goal should be to build a portfolio that can survive several different scenarios. Another major financial story this week was energy. Oil prices remained highly sensitive to developments involving the conflict in the Middle East and the possibility of disruptions around the Strait of Hormuz. On Thursday, Brent crude jumped sharply as concerns about shipping through the strait increased. By Friday, however, oil had eased as markets weighed the possibility of diplomatic progress and the latest U.S. employment data. That volatility matters because oil is connected to almost every part of the economy. When gasoline becomes more expensive, drivers feel it immediately. But the impact does not stop at the gas station. Higher energy costs can increase transportation expenses, shipping costs, airline expenses, manufacturing costs, and the price of many consumer products. That can create a difficult problem for central banks. If energy prices push inflation higher while economic growth slows, policymakers face a much harder decision. For households, the lesson is straightforward. Do not build a budget that uses 100% of your income. Leave some room for unexpected increases in transportation, groceries, utilities, insurance, or housing costs. A flexible budget is more valuable than a perfect budget that breaks a moment. One major expense changes. India provided another important global interest rate story this week. On Wednesday, August 5th, the Reserve Bank of India kept its benchmark repo rate unchanged at 5.25%. The decision was widely expected. The RBI is watching inflation carefully, especially because higher energy prices could eventually create broader price pressures. Reuters reported that Indian consumer inflation was expected to rise to about 4.5% in July, which would put it above the RBI's 4% medium-term target for a second consecutive month. Food prices are especially important because food represents a large portion of household spending in India. The RBI is therefore choosing patience rather than immediately changing rates. For consumers, the message is familiar when inflation is uncertain. Central banks may wait for more evidence before cutting rates. For borrowers, that means cheaper loans may not arrive as quickly as people hope. For savers, however, stable interest rates can provide more support for deposit returns. And for investors, India's story demonstrates why global diversification matters. Different economies can be at completely different points in their economic cycles at the same time. The United States can be worrying about employment. India can be watching food inflation. Japan can be dealing with currency pressure. Brazil can be cutting rates. There is no single global economic story. Japan also remained in focus this week because of the yen. The Japanese currency has been under pressure for months, and authorities have become increasingly concerned about excessive volatility. The yen strengthened sharply after the weak U.S. jobs report pushed the dollar lower. Reuters reported that the dollar fell against the yen on Friday, while traders remained alert to the possibility of further intervention. This matters even if you never trade currencies. Currency movements affect the price of imported products. They affect international travel. They affect tuition paid overseas. They affect money sent to family in another country. And they affect the value of international investments when those investments are converted back into your home currency. This is why currency risk deserves more attention from ordinary investors. You may think you own a simple global investment fund, but underneath that investment are companies earning revenues in many different currencies. Currency movements can therefore influence your returns, even when the underlying companies are performing well. Now, let's bring the global story back to Canada. The Bank of Canada is currently holding its policy rate at 2.25%. But one of the biggest personal finance issues facing Canadian households remains mortgage renewal. The Bank of Canada's Financial Stability Report estimates that some borrowers who took out 5-year fixed payment mortgages during the pandemic will face higher payments when they renew. The bank estimates that this group represents about 12% of outstanding Canadian mortgages, with average payments expected to rise by about 15% for some families. That can mean hundreds of additional dollars leaving the household every month. And that money has to come from somewhere. It may come out of retirement contributions, it may come out of travel spending, it may reduce the amount available for investing, or it may force the household to cut discretionary expenses. This is why mortgage renewal should be treated as a financial planning event, not simply paperwork. If your mortgage is coming up for renewal within the next 12 months, start stress testing your budget now. Calculate what your payment could look like under several interest rate scenarios. Then ask yourself whether your current income can comfortably handle the payment. If the answer is no, you still have time to make adjustments. You can increase savings, reduce discretionary spending, pay down expensive debt, or speak with a mortgage professional about your options. Preparation creates choices, waiting until renewal day creates pressure. Housing was also in the headlines in the United States this week. U.S. construction spending unexpectedly fell in June, with higher mortgage rates continuing to weigh on home building. At the same time, JP Morgan announced plans to deploy more than $750 billion into housing through 2035 as part of an initiative focused on increasing supply and supporting homeownership. For consumers, however, the most important number is still the monthly payment. When buying a home, do not focus only on the purchase price. Consider the mortgage rate, property taxes, insurance, maintenance, utilities, and the possibility that your financial situation could change. A bank approving a mortgage does not automatically mean the home is affordable for your lifestyle. The better question is whether the home allows you to continue saving and investing after the mortgage payment is made. Chapter 9, the financial warning most people overlook. After looking at all of these stories, there is one theme connecting them: financial fragility. A household can be doing fine today and still be vulnerable tomorrow. Imagine that your mortgage payment increases, then your car needs an expensive repair, then gasoline becomes more expensive, then your employer reduces over time. None of those events individually has to be catastrophic, but together they can create a serious financial problem. That is why an emergency fund matters, but it gives you something extremely valuable. Time. Time to find another job. Time to refinance. Time to sell an asset without panic. Time to make a good decision instead of an emergency decision. Your emergency fund is therefore not just cash, it is financial flexibility. So what should you actually do with everything we have discussed? First, review your debt. Write down every credit card, personal loan, auto loan, mortgage, and but now pay later balance. Then write down the interest rate and monthly payment. You may discover that one expensive balance deserves your attention much more than another. Second, stress test your budget. Ask what would happen if your income fell by 20%. Ask what would happen if your mortgage or rent increased. Ask what would happen if energy costs jumped. If the answer is that your finances would immediately become impossible, you have identified your next financial goal. Build more cash reserves, reduce high-cost debt, or increase the stability of your income. Third, do not let financial headlines control your emotions. This week, stocks rallied, gold surged, oil moved sharply. The dollar weakened, the yen strengthened. Interest rate expectations changed. Next week, the headlines could reverse. A long-term financial plan should not change every time the news changes. Use the news to understand the environment. Use your financial plan to decide what you should do. And finally, keep watching the numbers that matter most to your household: your income, your spending, your debt, your savings, your investment allocation, and your upcoming major expenses. Those numbers matter far more to your financial future than any single headline. And that is your global personal finance news flash for the first week of August 2026. The biggest message from this week is simple. The global economy is becoming more uncertain, but your personal finances do not have to become more fragile. Build liquidity, control expensive debt, prepare for higher costs, diversify your investments, and stay informed without becoming obsessed with every market move. Because the biggest advantage in personal finance is not predicting the future, it is being prepared when the future arrives. If this update helped you understand what is happening behind the headlines, subscribe to WealthTechSimple and join us for the next global personal finance news flash.
Thank you so much for watching. Click here to keep learning and leveling up. Don't forget to subscribe to join our community. Let's build your financial freedom together.